Based on the videos I have already made, I will guess that this video is for those ones who are already into Forex and they already have an account, and basically they are trading using Deriv.com as synthetic indices. Alright, so what I want to do or to show you, I'll just straight away go to this application which is MetaTrader 5 that I used to trade, right? So let me just click there, and I want to talk about the lesson of today, which is the bias, the directional bias, and that is bringing in the elements of liquidity grab before the price can continue its direction. So I'm here on VIX 10 1S on daily time frame, and as you can see, I have already made my markups. And what are these horizontal lines? For example, this one is a resistance. I have already marked here. As you can see, let me be using this arrow. Right, so you can see this is my resistance here, right? This is my resistance. Why did I mark this resistance? You can see this bullish candle was struggling to move up. It rejected, but buyers were strong enough here, so they pushed price up. So price tried to come back to penetrate through, but it failed at the first hand, so it continued testing this zone in vain. So until they had to grab this upper liquidity, right, this week, which did not close above. It is what we are calling external liquidity. So this liquidity came back, this time by sellers stronger. So at first, these three candles, they were struggling to push price lower, but they failed. So this bearish momentum candle is the one which closed below this resistant line. So we can see the second bearish momentum candle continuing down here on what we could call a support zone right here. Okay, with this yellow zone. So buyers are coming in trying to push price up again, because on a daily you can see we are still in an uptrend. But however, if you realize what happened here, this is a break, a change of character rather. So however, we still have an FVG here, the gap between these three candles, 1, 2, 3. So the gap I'm meaning is this one here, from here. Let me just show you using this one. So from here, right, it's an FVG, and let me show you another one. Let me just drop, and in between here, these are the two candles, the gap in between. But price has just filled in like a little bit of this one because it has penetrated, but it has not filled the whole of it. So for an FVG to be filled, it should be either 50% or the whole of it. So the 50% could be here, and this 50% is going to be filled. And my assumption is like price is likely to grab this this liquidity of equal highs here, where this hand this arrow is. Okay, this is what I'm pointing here is what I'm calling equal highs, which is liquidity. So I'm thinking price is going to move up from here, then to grab liquidity, then this resistant zone rejects the price, then it comes down to sweep this trend line liquidity, comes until it fills all this gap. There is also this FVG gap. Let me show you another gap I'm talking about. This gap from here, the gap here. Okay, let me get another line, and here. Okay, so the gap was of course between this candle and this one and this one. So I would begin from here, but these sticks or these wicks have just reduced or filled part of the fair value gap, but again they were not able to fill it even up to 50%. So which means this is the FVG which is remaining here, right? This is the FVG here, the gap in between here, this space, this one. Okay, this is the space I'm calling FVG, fair value gap. All right, so I'm thinking after price grabbing this liquidity up, it will drop down to clear all this liquidity. Alright, subscribe and turn on the notification bell icon to be notified of the upcoming lessons, and please like and share if you like such a video, and above all, peace, a nice weekend.